Hi, everyone. Thank you for being here today. My name is Tala Rohanian, co-founder of Restructured News.
And my name is Nina Gabbay, co-founder of Restructured News.
To give you all a little To give you all a little backstory, Restructured News was founded in July of 2021 after identifying a gap in the real estate industry where short form, aggregated, and easy to digest news did not exist. Since that point, we've been able to grow a readership base. We've been able to grow a team that shares the same mission and values as we do, foster important and informative conversations about the current and future state of the real estate market, and build connections and relationships with the leaders of real estate.
We're very excited to welcome you all to our first Restructured News panel event, Los Angeles in 2030, a conversation on the future of real estate. Professor Richard Green, the director of the USC Lusk Center for Real Estate, will host our conversation amongst our four panelists, Brett Nielsen, Saira Rahman, Chris Fraley, and Nisha Go. Today's event could not have been possible without our sponsors, so we thank you all so much. Thank you to our gold sponsors, Van Nuys, Jeep, Dodge, Chrysler, and the Rodeo Collection, our silver sponsors, Space Investment Partners and Mabubi Luxury Estates, our bronze sponsor, First Financial Capital, our coffee sponsor, Unincorporated Coffee Roasters, and finally, our pastry sponsor, Bon Appetit Pastries.
And now, we'd like to welcome and introduce our moderator, Richard Green, to the stage. Professor Green is the director of the USC Lusk Center for Real Estate. He holds the Lusk Chair in Real Estate and is a professor at the USC Seoul Price School of Public Policy and Marshall School of Business. He has also been principal economist and director of financial strategy and policy analysis at Freddie Mac.
Professor Green formerly served as the U.S. Department of Housing and Urban Development Senior Advisor on Housing Finance. He has also spent time consulting for the World Bank. Dr. Green earned his PhD and MS in economics from the University of Wisconsin-Madison and earned his AB in economics from Harvard University. And with that, Professor Green.
Thank you. And why don't we just bring our panelists out right now, and I will introduce them as they get seated. So panel, please come join me. And before I introduce the panel, I just want to say what a pleasure it is to be here. First of all, we were talking backstage about how this event came about, and I just have this, I love helping young entrepreneurial people, and Talar and Gabby just came across as that from the very first phone conversation we had. They called me up and they said, would you be willing to moderate a panel on real estate? And I said, well, who's the panel? And they said, well, we don't have one yet, but we thought we would start with a moderator. It reminded me a little bit of the Beatles song, Drive My Car. Remember that one, you know? But how does it go? I don't have a car and it's breaking my heart, but I've got a driver and that's a start. But they have managed to put together a panel, a wonderful panel as well. The other thing I want to just talk about, because we're going to be talking about the future of Los Angeles, is how appropriate it is to be in this hall talking about that, a hall named for Arnold Schoenberg. For those who don't know, I'm guessing most of you do, Schoenberg was a great composer and the leader of something called the Second Viennese School of Music. He was probably not the inventor of what was called 12-tone music, but certainly the most important exponent of it, most influential composer who would use this method of, he hated actually the word atonal music, but it's often described as such. And so for starters, I love Schoenberg. I'm very weird in that I've been known to whistle Schoenberg at times, which is not, I think, a very common thing for people to do. But the reason it's appropriate to talk about the future of Los Angeles in a place named for Arnold Schoenberg is Schoenberg was a refugee. He left Vienna in 1933. That was not coincidental. He was a Jewish guy, and Hitler came to power, and he knew he needed to get out. As did many other refugees from World War II who found themselves here in Los Angeles. Many of them, of course, started in New York, decided, weather sucks, I'm going to move to Los Angeles. And so there is this remarkable tradition of talent from all over the world, particularly when it's under stress in other parts of the world, coming here to Los Angeles, making it, in my view, now arguably the most culturally important city in the world. So when we talk about the challenges Los Angeles faces, and they're very real, I think it's important for us to remember that it also has this sort of special magic that has attracted people for hundreds of years, that has led it to be an attractive place for other people to come, because talented people want to be around talented people. Enrico Moretti at Berkeley talks about this in his wonderful book, The New Geography of Jobs. Agglomeration is a real thing. And I don't see that going away anytime soon here in Los Angeles and in Southern California. So as we talk about, again, some of the challenges we face here, I think it's important to keep that in mind. And with that, let me introduce the panel. So immediately to my, this is left, right, is Saira Rahman, currently Vice President of New Investor Initiatives at Fundrise, a financial technology company that operates an online investment program. She is also a derivatives geek, which we talked about before we came on stage just now. As a result, I'm going to ask her a few questions that I didn't know I was going to ask her as recently as an hour or two ago. And we're very excited to have her with us. Next to her is Nisha Go, a senior global luxury estates advisor at Sotheby's International Real Estate. After graduating with a bachelor's degree from UCLA, and by the way, this is not her first time here at Schoenberg Hall because she was a music major here at UCLA and a singer.
I just did something different.
Nisha joined Aaron Kerman and his team at the world-renowned luxury real estate brokerage Hilton and Highland. After almost a decade in the real estate industry, she's consistently been ranked among the top producing agents at both Pacific Union and Compass. And I think, yeah, it is right. So she has sold, over the last 3 years, over $250 million of real estate, which is, I don't know that I've ever seen a number like that over 3 years.
Well, and I'm really proud. My team and I sold over $260 million last year. So.
Holy Moses, okay. Brett Nielsen, next, currently serves as the Chief Operating Officer of Anderson Real Estate, a private family-owned real estate development and management company. Prior to joining Anderson Real Estate, he was Senior Vice President of Leasing and Asset Management at Caruso for 25 years. And you know, I think they've done okay. I think their asset management seemed to go pretty well over that 25-year period of time. And we're very proud to say, beyond the fact that he has degrees, 2 degrees from USC, he teaches for us and teaches very well. And I know students really talk you up about what a great professor you are. So it's great to have you with us. And finally, we have Chris Fraley, currently Chief Investment Officer of Realty Mogul, a real estate crowdfunding platform for non-accredited and accredited investors. Chris is also a partner at Forge Development Partners, a company that aims to create high-tech, sustainable workforce housing solutions for people at the urban core. He formed his own real estate investment company, Evolved, which allows individuals to buy and sell vacation rentals. He earned his bachelor's degree from NYU and a master's and an MBA from Yale. So we have a very wide variety of experiences on this panel. And I prepared them by I want to start with a bit of a softball question, which is other than interest rates and inflation, and the reason I'm saying other than is because it's all anybody is talking about right now. What is the thing that worries you most about, what's keeping you up at night now about the real estate market? And let's start with Chris and come this way, and then don't worry, we're going to go back and forth as to who goes first. I'm going to sort of have a random number generator in my head from here on to determine who goes first. But we'll start with Chris.
I think one of the things that's most concerning is demand. Just something that keeping an eye on. I think when probably about October, a lot of a lot of folks were thinking that apartment rental demand was going to go down, home sales value was going to go down. I watched that very closely. That does not seem to be happening. During the pandemic, we had such massive spikes of apartment demand nationally. We had about double, or maybe even triple, a typical year of net absorption on the apartment rental side, and wasn't sure whether some of that was going to trail back as a result of the recession, but it doesn't seem to be. So I think that all seems to be holding up pretty well.
So I think maybe what happened is that people finally moved out of their parents' houses.
Exactly.
And the parents decided, we really want you to stay away from our houses.
Exactly.
And so, yeah, that maybe they're even helping out a little bit with people, keeping people. What about, just a quick follow-up. The other issue along those lines is people certainly did leave our central cities during the pandemic, and there was a lot of demand in our suburbs. And in particular, here in Southern California, you saw the Inland Empire and Orange County have enormous increases in rents, and much more muted. In fact, rents fell here on the west side of LA for a while before they recovered to where they were before. But you haven't still had the kind of growth in rents that you had in those more outlying regions. Do you think people are going to come back to the center cities, or do you think they're going to stay put in the suburbs for a while?
I have maybe I'm biased because I live in LA, but it's such a great place to live. If you take the three cities that I focus on a lot, San Diego, San Francisco, and LA, I think from a rental perspective, LA has been pretty flat. San Diego was probably the second or third highest rent growth in the country. And San Francisco is still below pandemic levels. So I think it tends to vary between the three different cities. So it really on a case by case basis. But LA, I think there has been a lot of move out. I think there will. I think there'll be really strong demand going forward.
Brett.
Well, besides a new puppy that my daughter brought home, other than what's keeping me up at night, there's a number of things of what's going on. First of all, it's construction costs. Construction costs for me are keeping me up at night. It's concerning because you work on a project and you start with that vision and you want to, I want to develop. I want to see things built. And so when you see construction costs rising at the rate they are, I ask myself, when is it going to stop? Is it going to come back down? I do believe they will, because it's happened in all cycles that I've seen. So that is one thing. The other thing is the permitting process on both fronts. It's through the entitlement process. That phase seems to be, depending, especially in LA, it's very difficult depending on where you're building or where you're wanting to build. And time kills deals. And it's also on the operating side, because we're not only in the development business, but we've got operating assets. So on the retail side, I see these retail tenants that, they want to get built out. They want to start making money. We want to start collecting rents. And, I'm seeing that the permitting process, in some cases doubling and not only tripling in certain cities within our greater city of Los Angeles. So that is very discerning and hard to handle, because it puts a lot of pressure on the retailers. They want permit contingencies. We don't want to get them. And again, time kills deals. So the combination of those are really keeping me up at night, and really, I don't know how to mitigate those risks, because it's either going to be mitigated by the developers going to have to take on that responsibility, or it's going to be pushed onto the tenants from a retail perspective. And on the construction side, I don't want to go down the road and work on a project to the point where it doesn't pencil, because you spend all this time and all this money, and then of course, to get it entitled. So a combination of all of those are right now are really bothering me and concerning me.
Yeah, so that prompts, I have 3 follow-ups for you, but I'm only going to ask one right now. But on the cost of construction, how would you break it down between materials and labor? And are you seeing differences in the dynamics of both those sectors at the moment? Are you starting to see relief in one and not the other, or both, or are they still really tough for you?
Talking to me?
Yeah.
I'm seeing it just lumped in together. Most of it is, I'm seeing on both ends, and I'm seeing it with labor is driving obviously the construction budgets, but also it's the supply chain. trying to get, HVAC units and product, and that's a whole nother item that not only are those prices, because the demand is so strong, it's pushing those prices up, but it's also the timing too. So it goes back to that timing and cost, so it's both.
So, Nisha, how about you?
Well, I'm keeping with the theme because affordability and supply issues is probably what worries me the most. 60 to 70% of my business every year is done with new development and new construction builders. So I end up quite ingratiated in the process because now the project that was supposed to take 2 years to build is at 3 years, and the construction costs have gone up 20 to 30%. And a lot of these developers are looking at me saying, well, we have to pass those costs on somewhere. And so as a result, more and more new construction product is becoming more and more expensive. And I think the general affordability crisis in Los Angeles is getting even worse. So that's what's
So
keeping
where
me up.
are these projects located?
I have multiple projects all over greater Los Angeles area. So everywhere from Culver City to Calabasas to Beverly Hills to Brentwood. So what's interesting is I'm seeing everything from the $1.5 million to $20 million price point facing similar issues. But all of those problems are unfortunately being sort of passed down into the consumer.
But you're still seeing traffic that...
Oh, so much so. And that's why I think the affordability is such a big issue because we're selling these properties. That's not an issue because the supply is so low, because it is taking 2, 3, 4, 5 years to build the product. But unfortunately, what we're finding is more and more homeowners, especially in the entry level, are having to go outside of the cities or leave the state altogether because they cannot afford to live here.
Yeah, and one of the things that this may surprise people, but if you look at the principal source of out-migration from California, and we do have a lot of it, it's lower-income people. It's people making $50,000 a year or less. So there's long been a story that taxes have driven people out of California, and there's some truth to that. There actually, until a few years ago, we couldn't even find any evidence of that. But now there's some truth to it. Basically, the 2017 Tax Act, which limited the deduction on latent state and local taxes, we're finding that that is having an impact on out-migration on higher-income people. But still, it's overwhelmingly the case that the people who are moving out are lower-income people, and they're moving to Phoenix and Las Vegas. So they want to be kind of close to their families, but in a more affordable
in Florida
place.
and Texas, where they might be able to get a property and not have to pay those income taxes. So
Yeah, although we actually see very little of that. I mean, just the data. So we look at Postal Service data, we look at IRS data, and there's massive migration to Arizona and Nevada. There's some to Texas, and it's basically all Dallas. There's very little to Florida. It is kind of interesting. You need to be people need to be reasonably close before they move. Syra.
So I know that we're not technically supposed to talk about interest rates. I feel like everything kind of touches interest rates that was mentioned, though. So neither here nor there. I think the thing that I'm the most anxious about is the idea that interest rates actually continue to stay elevated. So not even what the interest rate is itself, but just that we're potentially facing a lot of pain with a lot of the developers that are attempting to do bridge loans and take on bridge debt in an effort to tide themselves over in hopes that interest rates will eventually come back down. And the question is whether or not they're actually going to be able to afford that if it ends up being for a prolonged period of time. So we're calling it the massive deleveraging at Fundrise, but I think that we're in for a lot of pain for a much longer period of time if that ends up happening.
So I can't help but ask, given what you just said, so you have Jay Powell's ear for 5 minutes. What are you telling him right now?
What am I telling him or what am I asking him? Am I advising him?
Yes, you were advising him. You were giving him advice. What are you advising him right now?
To shorten the amount of time that interest rates stay elevated.
Should they start reversing next month, do you think, or at their next meeting?
I don't know that we've hit that recessionary level where we could actually need the reversal. I mean, you're still seeing extremely low unemployment. You're still seeing wage growth. You're still seeing a lot of positive notes. I know a lot of people talk about a soft landing, but I don't even know. I don't know. I guess the way that I'm viewing it right now, I don't know that it needs to get higher, but I don't know that I'm ready for them to get lower yet.
But you don't.
I know I don't like it.
I beg your pardon?
I said I know I don't like it.
Okay, well, then I mean, I think they should have stopped a couple of months ago, but that's, and this comes to, are the inflationary pressures coming more from the supply side or the demand side? And in my view, they're more from the supply side than the demand side. And the key thing is we had very unusual amount of spending, good spending instead of services spending. And those are coming back into line with normal trends. And so as there's less pressure on the goods market, I think inflationary, and we're seeing it in data right now. I mean, inflation numbers have been looking good for the last 2 months now, but I could be wrong. I very well could be wrong. But I would have stopped. I would not have done the last increase and the one before that. But
And the one before that.
no, I think I would have done the one, honestly, I think I would have done the one before that, but because they were behind the curve. You know, I'm curious, Nisha, you say, Nisha, you're getting plenty of traffic, but who are your typical customers? What are they? Married couples? Are they singles? Are they from out of state or from the in-state? Are they young? Are they old? Who are you seeing?
All of the
buying
above.
stuff? Okay.
But it depends really on the demographic and what I'm selling in that moment, right? If it's the 1.5 million and it's adjacent to Culver City, you're getting more of the single or married couple, but without children, because they might be working in the tech hubs that are kind of adjacent to that city. So all of a sudden, the proximity and the convenience are ideal for them to live there. Otherwise, if you're spending $1.5 to $2 million, it begs the question that was asked earlier, why wouldn't you move to the suburbs if you can work remotely? So there's a lot of different factors that have shaped really the consumer's interest in where they end up living in Los Angeles. But if you're looking at the high end, a lot of my most recent transactions have actually been to out-of-state buyers and who do not intend on spending a full calendar year here. Likely for the tax benefits that we've discussed. So it really just depends. What has changed very palpably is what consumers are looking for in a space post-pandemic. Those amenity spaces, those work-from-home spaces, if you're looking at the high end, then you need to have a gym, you need to have a theater, you need to have space for your kids and your family to run around so you don't want to kill them, that kind of thing.
Well, yeah, I'm wondering, so what was a one-bed, I mean, I know you're selling homes and not apartments, but I'll just say, is the people who used to demand a one-bedroom, are they now demanding a two-bedroom? The people who demanded a two-bedroom, are they now demanding a three-bedroom? You get the idea.
Yeah.
I mean, my wife and I used to, when we worked from home, we worked together. We work in the same office, our home office. We like being near each other. But then when we moved to Zoom World, that became impossible. Because we're empty nesters, we have more space than we need, so it was totally fine. But in general, are you seeing people demanding one more bedroom than they were before the pandemic?
Yes, definitely. Because now you want a separate office space to be able to work in. Otherwise, especially if it's a person who's going to work remotely. And because so many businesses obviously, decided not to renew their corporate leases, that's something that's definitely part of our landscape now. I am representing a 63-unit apartment building that's going to be launching in Koreatown in March. And what's interesting about that is kind of tracking the demographics and who's going to take the micro units. Because now I think Los Angeles is starting to scale more vertically because of the affordability crisis.
So, Chris, do you guys invest in office space?
We do, yeah, a small
So tell us a
component.
little bit, and I'm going to come back and ask Brett about retail in a second, but tell us where you see the future of office in light of the work from home phenomenon.
Oh boy, that's a great question. I think that I'm a believer in office space, and I say that even though Realty Mogul has been remote since February 2020, but I mean we're already starting to see some cracks in that. I mean, there's about 20 people on my team. They're probably in 15 different states at this point, and it's not easy. It would be much nicer to be able to convene. A friend of mine's a venture capitalist in the Bay Area, and he told me that when when they started demanding that people go back into the office, they realized that a lot of people had two jobs. So I think that eventually we're going to. Some markets are obviously being hit worse than others. I think San Francisco is probably the top of the list in terms of pain right now, but I do believe in the future of office personally.
I'm just going to do a very unscientific poll of the audience right now. How many of you out there work what would normally be called an office job? Keep your hands raised, please. Okay. How many of you would love to have an office job where you never had to go into the office? Okay. How many of you would love to have the office job go back to where everybody goes in 5 days a week? Okay. There's a market study of future office demand for you.
Perfect.
Brett, let's talk about retail. So, retail has been going through tough times, and this is before the pandemic, right? And it's, I think, a wide variety of phenomenon, demographic. Amazonia clearly had an impact, but it's also demographics. And if I can talk briefly about your previous employer, I remember one time talking to Mr. Caruso, and he said, our job one is to keep people at the shopping center, and we measure how long people stay there, and so we need to have them have a reason to stay there. I guess, what are the reasons, what are the things that keep people there? And the more general question is, the data I'm seeing suggests we may have finally destroyed enough shopping centers in this country that we don't have an oversupply. I'd welcome your thoughts on that.
It's a great question. So there's a couple thoughts that come to mind. I mean, my prior employer spent 25 years at Caruso. We were all about, placemaking, sense of place, safe, secure, enjoyable. But also is that, the uniqueness of the retailers. And, we had a lot of the same tenants that were in, all the major malls and streets around the country. But it was really, creating that great sense of place. Now, retail is changing. We can do our part. Our whole idea as a developer that we felt, listen, we're going to do our part. We're going to build the great center, great sense of place. And then it's your job as a retailer to bring those tenants in. We'll bring them to your front door, but bring them inside and make the sale. So it was a partnership. What happened, I'm going to go off on a tangent, but it's kind of, I'll explain further. But you take a tenant that, I'll take a tenant, for example, American Girl. An amazing tenant, still an amazing tenant. And what they did is they were unique. There was only one in Southern California. They had New York, Chicago, and then they had LA. And all of a sudden, you had to come to the center, which, we felt we created a great environment. And then all of a sudden, you had a unique product. So all of a sudden, when you start seeing that same product, then they started to sell that same product in Toys R Us. So all of a sudden, the uniqueness is gone. So that is also happening in retail, and that's killed some concepts over the years where they start outletting it in Costco and other outlets, and so you don't have that uniqueness. That's changed as well. So then you go into a matter where you've got online, but also the footprints of retailers have changed. So as a development company, we would develop a certain size space. Let's just say a retail said, we want our typical footprints 3,000 feet, 4,000 feet. Well, now that same footprint is maybe a third of that. And the reason being is you don't have all the back of house. So that obviously shrinks the footprint of a required retailer. So the second and third generation tenants that would go into those retail spaces that you've developed maybe be limited, and a lot of them have gone away. And the reason why it's limited the back of house is because of all the logistic companies now. How you can, like Amazon. I mean, I use Amazon all the time, so I'm not. I'm probably not the best supporter of always retail brick and mortar, but you can point, click, and get that product here the next day. So that's what a lot of retailers are doing, are relying on those supply chain and those logistic type of opportunities that they can get the product in there. So it is changing. Retailers are changing. Uniqueness is changing. There just aren't a lot of unique retailers, and a lot of them are going away because of competition. So it's trying to reinvent. What I have seen, though, is a resurgence of retailers that say, okay, we have to do what you're all doing, Caruso. Not saying we actually, set the tone or really set all those wheels in motion, but they're now focusing more on placemaking inside and design and how to make it, interactive and that sense of place and the connectivity of human interaction, which people, when the pandemic hit, they realized how they want to get back to that. So they're paying a lot of extra attention to that inside the physical space themselves. Maybe there's a little coffee bar, maybe there's a little seating area, maybe there's a great sense of space and place of feeling inside, just like what we would try to do and create on the exterior. So it's evolving and retail's changing, and I think it's changing with the time. So a lot of change going on is really a long answer to your question.
So one thing we were talking about this backstage is what are the new anchors? So it used to be Nordstrom would be an anchor, and they would get their rent basically subsidized because they were bringing people into the mall that would then spend money at the other tenants. Now, thinking about it, I can think of only two reasons I've gone to a shopping mall in the last, I don't know how many years. One is I order something from Apple because it's not available at the Apple store. I want something bespoke, and I go pick it up because I don't want the Apple computer at my doorstep. I want to go get it. But the other is to eat. So we were kidding around, but not really. The Din Tai Fung is an anchor tenant now. In terms of their power as a tenant, are they starting to look like the old sort of department stores that would bring people into the mall, or are they still more like an inline kind of tenant?
They're acting as an anchor. So food and beverage is driving so much sales. It used to be the theater. Theater would drive in a lot of traffic. The anchor tenants like the Nordstroms, the Macy's, the Mervyns, all the ones that we grew up with would drive that traffic. But now it is the F&B, and that's really driving a lot of that traffic in. It really, really is.
So again, I'm going to do another unscientific poll here. How many of you out there enjoy going out to shop? There you go. Okay.
There you go.
You have a market. Okay. But just to be fair, how many of you, if you could, would never go to a shopping center again for the rest of your life?
Yeah. It's mixed.
For the other shopping, I do like picking out my own food. I don't do Amazon Fresh or anything like that. But all right, I'm going to. In a moment, ask Chris and Syra about their businesses, but before I'm sort of going to lead up into that a little bit with a question for Nisha, which is, would it be fair to say you are a traditional real estate broker? You're not. I'm sure you're very tech savvy. But you're about. You're not an iBuyer. Let's put it that way. You're not part of that market. Do you see the real estate brokerage market being disrupted? I mean, really disrupted anytime in the next 5 to 10 years? That's what, say, Zillow was supposed to be doing, right? And it didn't go particularly well for them.
I was hoping somebody would ask this or lead to this question, because our value as real estate agents is a very interesting topic. I know that in some cities like San Francisco, they were trying this I-model where, there wasn't really a broker involved, and you would let yourself into the house, and you would use an app to unlock it, and you didn't have anyone to show you the house. If you're in the valley showing real estate, it seems like you're out there with your Supra, if you know what that is, letting yourself into the house. I did it actually a couple of weeks ago with a friend of mine who went to UCLA, and I walked into a cobweb, like in the front door. And so I say this because I think that if the need for luxury real estate and that white glove experience continues to exist in specific markets, the role of real estate agents cannot be replaced by technology or a much lesser experience. I think just in the same that you go to a boutique and you expect to have water or champagne when you spend a lot of money when you're buying a luxury good, you want a similar experience, and it also comes with advice and years of counseling, by a real estate agent to do that. I do think that there is a market for it, however, in kind of more blue-collar communities across the United States. I personally just don't think that the Los Angeles, the New Yorks, the Miamis, the more metropolitan cities where people are still looking for that luxury experience and that advice, I don't think that we will become obsolete as agents.
Yeah, so it's really interesting the way you put it, because it actually struck me that the place where the disruption could happen. I wasn't thinking so much of cities per se, but I think Burbank is a lovely community, but houses in Burbank are kind of like one another if you go down a street. And so they're more a commodity than, shall we say, a house that Jennifer Aniston is flipping at the moment, right? And so I expected disruption to happen in that part of the business a while ago, and it clearly hasn't. So there's something else beyond just how special the house is, right?
Well, I think, so I'll give you this example of this house I was looking at in the Valley with a friend from UCLA. They are first-time investors. They're specifically looking for a duplex or a triplex or a single family with multiple ADUs so they can offset their mortgage. And because it's a friend, I'm taking a hands-on approach. And I realized all of the things that they didn't know about purchasing something like this. They're physicians, they're getting a physician loan. They're like, hey, we're going to be able to refinance, right? And I'm like, no. You're putting 10% down. Any secondary lender is going to want at least 20%. So whatever you get in appreciation isn't probably going to, you're not going to be able to finance it in the next few months. And then item after item of questions came up that I realized even in those markets, there's still going to be a need for a real estate agent because you won't get that information readily available to you on the internet if you don't know what you're asking.
So I now want to move, because I want to talk about how real estate is owned more generally, and I think a good segue into that is to ask Saira and Chris both about their businesses. So Saira, take a few minutes to just tell us what it is exactly that you do.
So Fundrise, as a fintech company, we invest in real estate all across the United States. Our thesis is specific to the Sun Belt. We do own a few properties in the West Jefferson neighborhood here in LA as well. But we essentially purchase and build properties within a multitude of different strategies, and we put them into non-traded REITs. And then we allow any investor to come in. You can invest for as little as $10. And you essentially have access to institutional grade real estate. We also, in July of last year, launched our venture capital fund. So we're essentially expanding into the entire world of alternative assets. But our bread and butter is really having vertically integrated the entire real estate segment. So we do everything from buying the tracts of land to building on the land to stabilizing, leasing, and then managing the properties.
So when you say a VC fund, do you mean that VCs invest in your fund, or are you saying you're the VC?
We are the VC.
Okay, and so who is it that are you funding real estate developers? I mean, who are you investing with your venture capital?
The venture fund is currently for prop techs, and then we also focus on data and infrastructure, but we write $5 to $20 million checks, follow-on only, non-board seat, and I happen to be one of the people that helped make that decision, so feel free to approach me if any of you guys are building companies in the growth stage, so B-ish or later, and that's...
Okay, so I want to come back and ask you a further question about that, but I promised Chris he could tell us about what his company is up to, so please.
Sure. So Realty Mogul actually, I think, started about the same time as Fundrise as a result of the 2012 Jobs Act. Though we do have a couple non-traded REITs, which are a similar model, but really the bulk of our business is giving individual and credited investors the opportunity to invest directly into a specific building or a specific development project.
I'm sorry, Chris, did you say accredited or unaccredited?
Well, for the individual private placements, those are accredited.
Okay, got it.
We do accept unaccredited investors in the non-traded REITs.
And just in case the audience doesn't know the difference, could you briefly explain what...
Oh, sure. So an accredited investor, the rules are you can qualify in a number of different ways. Either you have, I think that's $2 million of net worth, or there's an income threshold. I think it's $250,000 a year, or as a couple, there's another threshold there. I'm sorry, I can't remember the
That's
exact
all right. I just
details.
want people to get a flavor for what you're... So the idea is there are certain investments that are not considered retail investments, and so the general public needs to be protected from investing in them.
Correct.
And so it's your level of wealth or income that deems whether you are sufficiently sophisticated to make these investments or not.
Correct. I think that's, well, a good summary.
And so maybe either one of you, if you could talk a little bit about what is a non-traded REIT and how is that different from the sort of publicly traded REIT that people can easily find in the stock market, like a equity residential property or a Simon, or we could list a whole bunch of them.
So a non-traded REIT just means it's not traded on a public exchange. So the benefit of a non-traded REIT is that the correlation between public securities is not it's much less correlation between call it the equities market in general. So, for example, if you invest in a publicly traded REIT, typically, those are marked to market every day or every time someone invests, and there's a lot more volatility. In a non-traded REIT, it's a lot harder to go in and out. It's not as liquid, and so it's not valued as frequently as a traded REIT. I don't know if you want to add anything to that. Okay. Okay.
But I would, so we had a conversation backstage, Syra, and we were talking about sources of volatility or non-volatility, and you said something kind of interesting about that. So I'd like you to talk about that some more, about the issue of difference in volatility between the two types of ownership structures.
Absolutely. So with a non-traded REIT, kind of what Chris was saying, the benefit is that you do have a lack of volatility. The mark-to-markets are not done as frequently, and a big piece of the reason that it is non-traded is because it shouldn't really be a liquid product, right? Most people that are investing in real estate, they're investing for the long term. They're searching for the appreciation in that underlying asset. When you are in a public REIT, you face significant volatility because you have retail investors that are fickle, that are emotional, and that like to exit in and out of those REITs on a regular basis. And I think 2022 really demonstrated exactly how volatile that could be.
So are you saying our friends at the University of Chicago are wrong when they say that human beings are rational every single minute of the day?
I'm not actually answering that right.
Oh, all right. But that also is, so one of the things that was quite extraordinary is in early 2020, apartment REITs dropped, 30-40% in value very quickly. And nothing fundamentally changed about apartments. And you could even make a case that, okay, because of the pandemic, apartment owners would go a year without income. You still wouldn't see a 30% drop in value of that REIT. So yeah, there is no doubt that there is stampeding behavior in public markets at times. But what I do want to raise with you both is the fact that, yeah, they don't look volatile, but underneath, it's basically because you're not measuring them all that often. So you're marking them every quarter. You have appraisers come, you value the property, determine what it's worth. You can say what you will about the quality of that, but I'm not going to have an argument. It's okay. What they do is all right. But what's really going on underneath the hood there? And is that something that investors in non-traded REITs should worry about?
Do you want to? Oh, no, I'll start. One of the things that I do is partially get myself extremely involved on that side of things. And I mean, when you have a non-traded REIT, you have to have precision behind your financials and precision behind your audits because of the fact that everyone does kind of hold you to this higher standard, because we end up becoming the villains in a downturn because everyone will turn and say, what's going on with B REIT? What's going on with S REIT? Why are these somehow magically outperforming? And from my perspective, I don't think that our processes need to be such that we're valuing every single day on every single property. I find that having a mark-to-market, whether it's daily, monthly, or quarterly, is more than enough for our underlying REITs. I mean, to not need that level of volatility when you have quarterly redemptions makes it significantly easier for our investors.
So, and excuse me, ladies, because of the way the light is shining off my watch, I can't tell what time it is. Where are we right now? Where are we? 3:17. Okay, good. We have some more time then. But see, I should have brought my Apple Watch for this. I want to switch gears altogether and ask a couple of broad questions of the whole panel. And the first is about, I want to bring us back to Los Angeles. And we talked about already some of the frustrations in Los Angeles. The leading one, I think, is just how long it takes to get anything done. And there's no gainsaying this. Is one of the things that just astonishes people who work here is that the average time to getting a building permit nationwide is 29 days. Yeah.
That's nauseating.
And so given where we are, that means there are a whole lot of places that it's less than 29 days, right? There are a whole lot of places in the US where basically people don't know what you're talking about when you talk about entitlements. There's zoning. And either what you want to do meets zoning or it doesn't, and if it does, you get to build it, and if it doesn't, you don't. And it's as simple as that. Whereas here, pretty much anything major involves a process that goes beyond the question of whether it fulfills the requirements of zoning. So this is a different and problematic place. That said, looking at 10 years, are you bullish on LA, bearish on LA, neutral on LA? How are you feeling? And since, she's on the ground every day, I'm going to start with Nisha on this one.
As far as values go, I'm bullish on LA. As far as quality of life and diversity, I think that's where there's some more room for concern because of the growing affordability crisis. But as you were speaking, I thought about the other side of the coin to everything we're speaking about, which was the discussion I had with one of my really good clients and friends who's the founder of Zonda, who's a real estate technology firm. His chief economist actually meets with Jerome Powell every month. There's 4 of them that they have this meeting. So they're really tracking a lot of these numbers and really what's going on. And he said something really interesting to me, which was that their forecast states that anywhere where it is really difficult to get permits, the values will probably stay relatively high or not experience as much volatility as markets where supply will meet demand. So in the markets where it only takes you 6 to 8 months to get plans approved, permits done, and have a house built, all of a sudden, because there are so many options and less demand, those prices have already gone down 15 to 20%. Whereas in the greater Los Angeles area, we're actually only down about 4 to 6% in median pricing, depending on which study you look at.
Well, and given how high, now I am going to raise the question of interest rates, given how much mortgage rates have raised, that's an astonishingly small number. Yeah. Just here's a fun fact for you. If you go back to 1998, which is when the consistency in the CPI rent series begins, LA has had the fastest rent growth of any major metropolitan area in the United States, with considerably less volatility in that growth than most other markets. And in fact, Atlanta, which is a very rapidly growing city, of course, has far more volatility than Los Angeles does, with much lower rent increases. So from a sort of alpha standpoint, the LA real estate market has outperformed. Now, past performance doesn't guarantee future results, so we want to be careful about that. But it almost certainly relates to this phenomenon that you're raising, is when it's hard to build, it means that once you're in, you're probably going to do pretty well. And so I want to continue with the LA question, but Brett, I also maybe want you to think about, what would be the Goldilocks permitting requirements? So if anybody can just pull a building permit anytime they want, you're not going to get appreciation in your real estate. There's always going to be too much competition. But if you're in California, it just drives you nuts, so that can't be right either. So do you see, as you're thinking about LA in general, what would you think a really good planning regime would look like here?
Well, I'm gonna take a step back. You said the word entitlements, and entitlements, as I tell my class, and there's some students out here, it's an entry ticket to development. So once you have your entitlements, that's where you create your value, and it's those high barriers to entry. That's really what we're talking about. So once you're in, and that's great. So the perfect regime in LA would be a fast tracking. There's 2 processes. First, there's entitlement phase, which it could be very difficult once you've got that project entitled. That's great. So that's the high barriers to entry. But then once you get those entitlements, a fast tracking approach to get to the fact you can get through the building department, that's what I look forward. And if you can fast track that part of the process would be ideal. And that's not only on the entitlement side of building, but then you get from a retailer's perspective, trying to get these retailers who, quite frankly, a lot of these mom and pops, which communities want. They don't just want the nationals. They want the soul. They want the community feel. They want these uniqueness. Small mom and pop operators cannot go through 29, 30 plus weeks of permitting. They can't afford it. So we need to have a very fast track permitting process for those type of businesses so they can get open and operating. Otherwise, they're just gonna say we're gonna leave or not open up at all. So two different types, in my opinion, from a permitting process.
No, and that's
That
an
makes
important
sense.
distinction to make. I mean, one of the, I sometimes have Singapore envy. In some ways, no, but in other ways, yes. This is not about entitlement. This is their permitting process. On average, takes a week from the time you take the plans to the desk to the time assuming everything's okay. But your plan check takes a week.
That's great.
So, Chris, LA, what do you think?
Well, there are two challenges that we haven't even talked about that are very specific to LA. And the first is, there's a whole industry out there of litigation attorneys that kill deals. I've never seen anything like it. I worked in New York for 25 years. I've developed in San Francisco and San Diego and, all throughout the country. And it's astonishing. And, you can get your entitlements and then, your neighbor or there's a handful of attorneys that are out there that just have to be stopped somehow that, flat out extort developers. So that's one problem that is very unique to LA and is only going to make
Does that have something to do with the fact that we've had 3 city council members arrested by the FBI in the last
might have something to do with it.
May have something to do with that.
But that's actually a whole other issue because these are independent litigation attorneys that make their living off of suing developers and basically stopping the housing production cycle. The second thing, which is also astonishing, is this Measure LA that was just passed. And prior to being passed at Realty Mogul, we were underwriting 2 or 3 development deals in LA. And the measure killed the deals. If you think about it, a 4% transfer tax doesn't sound like a lot, but on a $100 million development project, you now have to pay $4 million. And from a developer's perspective, a lot of that is leverage. Let's say you're 70% levered. You go to sell the property. You have $30 million of distribution on a $100 million project. You now have to pay over 10% of your distribution as a transfer tax. And that's the developer's profit. So the profit's gone. So the deal doesn't work anymore. And the deal gets abandoned. Now, San Francisco has taken it one step further. Theirs is actually 6%. And that's been around for a little while, but so I'm from an owner's perspective, for someone that owns existing product, LA looks great in 2030, but for a tenant, for a home buyer, it looks pretty grim.
I was on a call just the other day, a Zoom meeting the other day, and there was a guy, I was on a panel with a guy who was one of the advocates for that tax. And I said, basically what you have done is what you described. And I said, it'd be one thing if you had a capital gains tax. If you're sitting on a piece of land, the value of the land goes up. We could argue about that too, but it's not going to kill development. Whereas you basically have a 5% surtax on new development now. And he says, yeah, maybe we should have made it so that the first sale was exempt. And I'm thinking, well, duh, but you didn't. And so the other thing I have to say, years ago when LA added a linkage fee to new residential development, I was called down by a guy at the mayor's office because I thought it was a terrible idea, and he was trying to convince me that it was a good idea, which he wasn't going to do. And I said to him, look, if people are starving to death, you don't tax farmers for growing food. And that's what we do here in LA. It's quite astonishing. but only in the city, in Santa Monica now too, but there are places that that's not true. So when I'm saying LA, I mean the region. I'm talking about the economic entity, although the city matters as well. So, our newcomer to town is Syra. So you've been here a little while. What do you see for the future of LA? How are you feeling about it?
I mean, I guess it depends. So my entire family is kind of unique. We all came from Tier 2 and Tier 3 cities, and we moved into California post-pandemic. So my parents live here. My sister moved here for her residency, and my husband and I followed shortly thereafter. So we came here for the sunshine and for the better weather. And I know it's called the sunshine tax, but I honestly think there's so much more that comes alongside it. So it would be hard for me to say that I'm not extremely bullish on Southern California generally, because I finally think I've found a place where we're going to stay for a very long time. But I mean, generally speaking, in terms of the properties that Fundrise has here, I mean, we've struggled. We own some really beautiful buildings that we've been renting out, some of which we're still in development on, one of which has been essentially taken over. We had a hard time trying to get those, I'm going to call them tenants out, and we honestly feel like we're kind of at a loss because it's extremely difficult to get anything done down here. So we've essentially removed Southern California from our strategy because it just doesn't make sense for us to put forth that much effort and time and money to continue developing here.
So as a person, you're bullish, but as an investor, you're bearish.
Yes.
Last question I'm going to ask you, and then can I open it up to the audience for questions for a little bit? Is that all right? Okay, one more question for the group. Given where we are financially, let's just divide assets into three types. I know there are others, but I'm going to divide it into three. You have stocks, you have bonds, you have real estate. You're reallocating your assets. How are you reallocating them, if at all, right now? And I'm going to start, Syra, with that one.
So I'm going to sound like a boomer. My retirement has essentially shifted entirely into Treasury bills because I think that is the only source of guaranteed income right now. So I took my entire 401k and have rolled them into various maturity of treasuries. I still have equities. I mean, I bled out on some of that loss, and I'm just kind of holding and waiting on those now.
Okay, I was asking in the abstract. You didn't need to
Oh, sorry.
your finances, but
Got
that's
deep.
all right. No, I don't want to put you personally on the spot. How about Nisha?
I would go 50% bonds, 50% real estate. To me, the volatility in the stock market scares me personally. And I invested in crypto, and that went really well. So,
I would have told you not to do that. I promise you.
Okay, fair. But
Cash flow, man. Always cash. Look for cash flow.
Exactly. So, I mean, look, bonds are probably the safest thing out there, in my opinion, right now. And then on the real estate front, I actually shared a quote this week, which was quoted by Will Rogers, or Will Rogers said it, and he said, "Don't wait to buy real estate and wait." And especially in a market like Los Angeles, for all the reasons that we've discussed, I think I'm super bullish on the value of real estate. And the other thing we haven't really talked about is there's no land left. So inherently, that land has a value, and I believe that the more that I purchase, and that's what I'm looking at now, is development and purchasing passive income properties in the residential space. That's going to be the safest investment and what I want my future portfolio to be.
Brett?
First of all, long-term perspective on all. I would go 70% real estate. Again, long-term perspective, long period of hold, and 30% in stocks and bonds. But again, with a long-term perspective.
And Chris?
I'm a little biased, but on the risk component of a portfolio, I would go for real estate strategies where you create value, like development, like value add, like where you're creating value in real estate, not necessarily just collecting the income component.
So let's open it up. Any questions from the audience for this terrific panel? Yeah, I see a hand in the back there, sir.
So you guys talked about how rent's getting expensive, and one solution is to build vertical But in LA, it's not that easy. You know, we have old zoning laws, probably got to relocate people, you talk about construction costs. So having said that, if you could snap your fingers and, you know, enact policy or legislation to entice more development, what would you guys do?
I'll take the lead on that one. I think that the red tape that's involved obviously would be the first thing that I would want my magic snap of the fingers to, you know, cure or fix. There are a lot of new policies basically put forth as far as creating more affordable housing and in exchange builders get an urban density exemption. So, you know, if by right you were allowed to build 26 units, if you allocate 10% of it or 15% of your project, now you can build 34, 36. I think that honestly the scope of where we'll be in 2030 is going to be more vertical. I think it's just going to take time because nothing moves quickly in Los Angeles.
So there's a guy who wrote his PhD dissertation here at UCLA named Greg Morrow. He's now on the Berkeley faculty. And he did a history of zoning in Los Angeles. And in 1961, the zoning envelope in Los Angeles allowed for 10 million people to live in the city. With a series of downzonings that followed, that envelope fell to 4.3 million people. Okay, we have 4 million people. We have basically hit the zoning envelope. Now, some of the things like ADUs and SB 9 have loosened that up a little bit, but fundamentally, zoning in LA is just wrong for, you know, we're somewhere between the 14th and 20th largest metropolitan area in the world. Right. In the world. It depends on how you define metro area, but we're in the second 10. Go to any of the other 20. Go to the downtown, stand on top of a tall building. It doesn't look like LA. In that you're not going to see seas and seas of single-family houses. And I think without that fundamental change, and it will change the quote-unquote character of Los Angeles, there's no question about it, this is not going to be solved. Any other thoughts from? I mean, I think Brett talked very well, you know, the permitting process, which is a separate thing from zoning, just time is money. Every day that goes by, the development becomes less profitable because the developer has to pay bank back and limited partners back, and so I think that's important too. Yes, sir. Builder's remedy.
Yeah, I mean, I do have some knowledge. Basically, if I understand it correctly, the state gives all the municipalities within the state of California a deadline to hit a housing goal and come up with an affordability plan. And most cities are not hitting it. And when that deadline occurs, there's supposed to be theoretically a free-for-all on zoning, and developers will be able to build whatever they want. You know, in one of my projects, we're actually, you know, in litigation with the city of San Francisco for their denial of some permits, and you know, we thought, oh, well, gee, this will be great. You know, why bother negotiating with them? You know, the date rolls around and we'll be able to do whatever the hell we want. But in theory, I think that's you know, it's really a great idea and a great hammer from the state, and I'm so thrilled that the state is actually trying to take action and you know, reduce the obstruction throughout some of the cities and municipalities in California. I don't know how it's going to be implemented. Sure. Yeah,
So yeah, there's a developer in Santa Monica who has used builder's remedy to get permitting for, is it 4,000 units? It's a good number of units. And the question was, will it be challenged in court? I think we can safely say yes. Will it be overturned? I mean, that would require a legal scholar. Do we have a legal scholar in the House? Is there a legal scholar in the House who can interpret how California courts interpret laws?
Well, I don't think anybody can do that. But.
Okay, all right. So No, I think we're all kind of waiting to see what will happen. Yeah, no, there is. I just don't. I think until it works its way through. California courts have had some very unusual interpretations of CEQA, for example, the California Environmental Quality Act, so it's really, really hard to say.
But if I can add to that,
Yep, please.
I've got two projects, or two pieces of property that I'm going to redevelop in Beverly Hills. And Beverly Hills has a mandate right now, 3,003 new housing units they need to do in. And I'm not into the city yet with my entitlement package, but I will be very shortly. And I'll be honest, I'm not picking on City of Beverly Hills. I'm just talking about, obviously, this new mandate. I'm not going in saying, gosh, this is going to be a slam dunk, because I don't feel that it will. I think it's going to be city by city, and it depends on how protective cities are going to be and not really caring about the mandate. I'm not saying City of Beverly Hills isn't going to care about the mandate. I'm just talking about it in general. So I'm not as optimistic about it in how it's going to work, in my opinion.
I think we have time for two more. Yes, sir, here.
Some of you talked about incorporating real estate into your portfolios. I was just wondering whether that would be more residential or commercial, inside of California or outside, and why?
I'll take that. I mean, I personally, I would be both. I've actually doing stuff outside of Los Angeles on a personal level, and getting into student housing around universities around the country. And yet, on the commercial side here in Southern California, which is the company I work for, we're primarily commercial, but we're getting into the multifamily business and getting away from office. And I'd like to focus personally more on retail, but depending on the location. So multifamily, retail, and then focusing on student housing around universities.
Please.
I have a particular bias towards residential. So, everybody needs a place to live. So for me, residential is my particular real estate focus. But that is then splintered off into two sectors, which for me is development and then rental properties, passive income, both multifamily and, just more luxury houses that actually accrue a really nice cap rate. Now, the question about whether or not you do it in California or outside of California really depends, in my opinion, on your investing style. A lot of really apt investors that I work with in Los Angeles do not just own real estate in California. They have property in Las Vegas. They have property in Missouri. They have, so what they've done.
Missouri?
Yes, I know. Kind of strange, but all over, and the reason they do this is because they obviously make much higher returns in slightly more volatile markets, right? So Las Vegas would be one, but they offset it with the stability of investing in California prime markets. So that's their investment style, and I think everyone should ask themselves, what kind of investor am I? What kind of investor do I want to be?
Sir, over here, blue shirt. In the world. We're second in the country, yeah.
It's definitely fair to say that we have no way to get transportation of those cities. Do you think that as we start shifting to more transit-based lines, LA is obviously a huge push for those, we'll see density being a little bit higher, and we're pushing from higher structures instead of just staying single family? Or do you think even as we put trains in, we're still going to be staying as multi-family, single unit buildings?
That's very interesting.
It's a question about as Metro Rail expands, will that lead to a greater desire to live in multifamily buildings because the transportation network will change? Is that a fair summary of the question? Please.
I can kind of speak to some of the trends that we saw or are seeing at Fundrise, which really in 2016, 2017, you started to see this shift within the millennial generation of more people wanting more space. So we had all these multifamily buildings, and on the first floor, we would offer like a garden or like a semi-backyard to the first floor units. And we found that we could rent those out for anywhere from 20 to 30% over the list rent, and they would have wait lists, even though we were able to rent them at that higher rent pricing. So we eventually shifted to what we call build to rent, which is where we started building homes for millennials to be able to rent as they were growing their families and becoming older. And really that's become a significant portion of our strategy just because people want space. And like that's like one of the biggest benefits of living in LA is that you not only get the house, but you also get to be in the city. So I think as our population continues to age, that's just the general trend that we've been seeing at Fundrise, but I guess I would be curious to see if anyone else disagrees with that.
Well, I guess the one thing, building tracks is not enough. It also is how well does the system work. And I'm actually a transit junkie. In my nightstand drawer, I have about 30 Metro passes from around the world. And I can say with a lot of confidence on an operations level, which is headways, how frequently does it come? How clean is the bus? How pleasant is the train, et cetera? LA ranks dead last. And so now I have to say around here, like the Big Blue Bus in Santa Monica around here is fine. If we had that standard of service in LA Metro, I think it would be more appealing. But until we have a more customer-focused transit system, I don't know that building miles of tracks is actually going to matter that much. But I think you're absolutely right. There's an interaction between how vertical a city is and how people get around that city. And I'm glad you raised the issue. Just any other comments on?
Go ahead. No, go ahead.
I was just going to add. I mean, we've got the company I'm with. We have property. We own most of Westwood Village actually, and with the new metro coming down here, and also through Wilshire and Beverly Hills, I'm optimistic that it's going to allow for future development to increase density for all the right reasons. So I've never been really optimistic about metro in Southern California, and now looking at the locations of where we have properties and how it could really impact the community, but also impact us to be able to develop, I'm very much more optimistic about it. It's all about the user. The user's going to use it. I mean, that's really what it comes down to, and that's, I think, yet to be told.
So my opinion is really based on how I've marketed towards, in communities, projects towards metro line or transportation being accessible. And what I've found is because the experience is so poor, none of those people use the metro regularly, and that's not why they bought into those communities. I think if the experience is improved, I mean, I'm sure, did anybody take the metro to get here today? Right, because it's not actually really widely accessible. The way that the maps are done, you need to use the metro in a way where it's not really feasible, I think, for most people to use it every day. So I do think that, in kind of more the urban dense areas, it'll become part of that user experience. But for now, I haven't seen it be anything of a draw for residents.
And on that very encouraging note, I think we've reached our time. I'd like to thank Brett Nielsen, Saira Rahman, Chris Fraley, and Nisha Go for their insights this afternoon.
Thank you to Chris Fraley, Brett Nielsen, Nisha Go, and Sarah Rahman, who made today just amazing. I personally really enjoyed listening to all of you, and it means a lot that you've joined us here today.
And we've learned so much from the 5 of you, not only today, but throughout the process of putting on this panel event. So thank you for believing in us. Thank you for jumping at the idea of, speaking, moderating this panel event, and our first panel event too. And we really look forward to many more opportunities to spark conversations that shape our perspective and restructure the way we see the world. So thank you all for being here. To the audience, thank you. Have a great rest of your day. Thank you.